welcome to Lendy's final financial and property update for 2021. Unbelievably, we are indeed at the end of the year, and what a year it has been. In today's video, we'll be discussing the latest trends in the property market, banks hiking up their fixed rates in November, and whether we'll be anticipating a rise in the cash rate sooner than we may be expected. With me today, we welcome back David Hyman, our co-founder and CEO of the Lendy Group. Welcome back, Dave.
Thanks, Zara. It's great to be back.
Let's dive right in then. As always, can you give us an overview of how the property market performed in the previous month?
Yeah, I think that's a really good place to start. So I think everyone who's watching would clearly be aware of the meteoric rises we've seen in house prices over 2020 and 2021 in particular. So in the 12 months to October, we'd seen almost 30% rises across all the major capital cities and even in sort of regional areas as well. So we've had, extensive levels of growth across the country. And, when you sort of dive a little bit deeper, there are pockets of places like Sydney and Melbourne and Brisbane, and even some of the regional areas where we've seen rises ahead of those rates. So I think the question in everyone's mind is, how long will this keep up for? I think if you hold property, clearly you're looking at your equity value going up, and if you're looking to buy a property, it's becoming more and more out of reach, in particular for first home buyers. So I think it's important that things taper, and we're starting to see some of those early signs now. So while November was up by 1.3% across the country, that's the slowest rate of growth we've seen all year. January was about 0.9% and was the nearest month to November. And so we're starting to see some of the other indicators slow down as well. And this has really been driven by, while interest rates at a whole are still at record lows, we've actually seen a lot more stock come onto the market. So as Sydney, Melbourne and other parts of the East Coast came out of lockdowns over the last few months, that confidence level's come back into the market. People have put their properties on the market, also driven by obviously the high prices and also the mobility between metro and regional areas. And we've seen those higher stock levels lead to lower auction clearance rate levels. So we're now seeing auction clearance rates in the low 70%, when we were seeing them for a sustained period in the 80s and even sometimes in the 90% range. Those are all healthy signs, because that does show some tapering of those meteoric price rises, which aren't sustainable over the long term. And we expect that if these stock levels to persist, that we'll see more of that tapering as we kind of come into the start of 2022.
Thanks for that, Dave. That was really interesting. In the home loan market, though, we have seen a surge, probably just in this last month, around refinancing, and probably being driven particularly by those homeowners who are trying to get ahead of this sort of rate rise that we're seeing around, from some of the bigger banks, and they're looking to fix. Can you maybe share some insights on this and your thoughts? In particular, maybe whether you think the RBA will be putting up that cash rate sooner than potentially we expected?
Yeah, absolutely. Look, I think probably just to start there, so you mentioned fixed rates. One of the features of the government stimulus package when COVID-19 was first emerging last year was a thing called the Term Funding Facility, which was effectively very, very cheap fixed rate debt for the banks to be able to lend out to their customers. And that finished a couple of months ago. It was a huge feature of the pandemic response, and it was one of the things that underpinned these really low interest rates, which have helped drive record activity in the property and mortgage market, which has driven a lot of economic activity. But as we start to wean ourselves off that stimulus measure, what we've seen is the wholesale cost, or the cost to banks to ultimately provide those fixed rates to customers, has been going up, and as a result, banks' fixed rates have gone up over the last month or so in particular. And in some cases, we've actually seen a couple of rate rises. There's a couple of banks we've seen actually do 3 rate rises in the last 4 weeks on their fixed rates in particular. So it's definitely happening. It hasn't happened across the board. And so, for those people thinking about potentially refinancing and fixing, and as you mentioned, Zara, there's been a rush of people to do this. There's still lots of opportunities out there, and even though we've seen rises, there's contextually historic lows, albeit they were a little bit lower last month. In terms of where that goes, in terms of the overall underlying interest rate, the RBA has been out there publicly saying we're not going to raise rates till 2024. Now, clearly, things may happen, or economic conditions or market conditions may dictate a rate rise happens sooner. And the things that I guess the main thing that will really feed into that is, where does inflation feed in? So across the world, we've seen inflation rising. There's been unprecedented levels of stimulus, well ahead of any wartime effort or any other historical event. And what that's done is put a lot more money back into the system, into consumers' hands, which is driving prices up. There's also been some major supply chain issues driven by the COVID pandemic and other related flow-on effects, which is also driving the supply side issues, which is causing prices to rise. But ultimately, the RBA really wants to see a sustained period of inflation in that sort of 2 to 3% range for a number of quarters, and we haven't yet seen that. So we don't expect any short-term rate rises, but that's going to be the key thing for people to kind of keep an eye out on as the leading indicator towards, is the underlying cash rate going to increase over time. In the short term, variable rates are still very, very strong, and the number of fixed rate products are still very, very strong. So if you're sitting there thinking, should I refinance? The answer is yes. The time is now. The rates are low, and there's never been a better time to kind of look at locking things in.
And just on that note, Dave, from your point of view as someone who's been in the industry a while and sort of sees the trends, what advice would you give to a homeowner out there, maybe such as myself, who haven't yet fixed the rate, but they do look quite compelling, but not sure what's going to happen to that cash rate, lots of ambiguity there? What would your recommendation or what would your advice to those homeowners potentially be?
Yeah, absolutely. So look, I think the first thing I'd say, I'll give some general advice here. I think the first thing I'd say is speak to a broker. Brokers act on your behalf, and they'll be able to take all of your circumstances into effect to work out what the right thing to do is. But there's a bunch of different things you can do as it relates to fixed rates. So as a generalization, fixed rates are really there to ultimately lock in certainty around what price you're going to be paying on your mortgage. And when you look at where we are on the cash rate cycle, the cash rate being 10 basis points or basically zero, clearly fixed rates aren't going to go down from here. And if they do go down, it'll only be in a small amount. So the thing to think about when you're looking to fix is how much flexibility do you need? Are you looking to sell your house? Do you want to make extra payments, et cetera, et cetera, et cetera? So if the answer to those things are no, no, and no, well, you can fix your rate for 2 or 3 or 4 years, depending on where you want to land. And there's some really, really competitive offers around in that space. The alternative, though, if you want some flexibility, is you can fix part of your loan and you can leave the other part on variable. So, for example, if you get large bonuses once a year, or you want to have some money sitting in your offset account, and look, by the way, some lenders do allow fixed rates with offset as well. But to the extent that they don't, you can split part of your loan being fixed and part being variable to get that benefit there of whether it's offset or more flexibility. But ultimately, really, the key message here is there's lots and lots of options out there. There's no time like the present, and you should be speaking to a broker around the best pathway through.
Sound advice as always. Thanks, Dave. And obviously that is just advice. It isn't financial advice in any shape or form. But that does conclude our final monthly update for the year. I hope you have all made it through this year relatively unscathed, and we're hoping for a much more easy 2022. Christmas is just around the corner, so it might be a good idea to put some cash back in the pockets and spend it on yourselves and your loved ones as we start 2022 in a great financial position together. So please click on the subscribe now button if you want to see more of our financial and property content, but we look forward to seeing you in our next update in the new year.